If I'm a long-term investor, should quarterly results even matter to me?
Do I even care about this result? I don't, it's going to be a non-event, move on.
Expectations matter a lot to you as a buy side or a sell side guy.
What I want to seek is how do the quarterly results change my earnings and how do they change my valuation? Numbers don't lie.
How do you see between what's right, what's not, and you can catch, okay, maybe what this guy is saying is not really 100% truth and there's got to be some catch here.
Infosys is a great example of always under-promising and over-delivering.
So the observation is the 70-30 part. Okay, where's the capital going? But the analysis is everything that happens after.
You may write a 100-page report, but if you're not able to tell me the crux of it in a line that is not more than 20 seconds, I'm not sold on this.
Hi guys, welcome to another episode of Subtext. I'm Kashish Kapoor and today I have with me Sagar Lele. He's an executive director at Paterson Securities and he's been working in the markets for over 14 years. In this conversation, we talked about how should you look at quarterly results, and because he's been working in the industry for this long, I thought it will be good to have an analyst view at it. We at Daily Brief usually cover these stories about sectoral results in the quarter, but they're more from a very geeky angle and rarely I think we're able to do justice to the intense research that these analysts do. So I brought him here to maybe steal a few ideas from him, how I can do my job better. That's all I'll give for now, and I'll let you enjoy the conversation. Welcome to a Subtext episode, Sagar. Thank you so much for coming here. So today I wanted to talk to you about how to look at quarterly results. The thing is that when we started our Daily Brief, every day we pick a couple of stories to write on the markets, and we realized that since we're writing for an audience who's interested in the markets, it only makes sense we also, cover these companies and look at their quarterly results. It also was an easy hack for us to pick stories because we knew every quarter we'll have thousands of companies releasing their quarterly results. So we can just pick a couple of companies in each sector and do that story. When we started this process, a lot of sectors that we were covering were very new to us. And we were always looking at these stories more from a very geeky lens, trying to understand what these businesses were doing and trying to relate it to how can we learn more about the economy. Eventually, we also started taking in a lot of processes that analysts like you and hacks that analysts like you take to have a better read of the quarterly results and have a more analytical angle, just in general. So this is a very selfish attempt, honestly, on our part to make sure that we make our process a bit better so that the next quarterly results that we do, the story that we do, it has that analyst angle to it as well. But at the same time, it serves the purpose of our audience trying to learn a thing or two about the business or the industry. So that's the context for the conversation that we're going to have today. That said, Sagar, why don't you introduce a bit about yourself to the audience so that they understand why you're here and why you're the best guy, according to me, to talk about how to read a quarterly result.
Happy to be part of this selfish attempt as well as a little benevolent on the users or the viewers side. But it's okay. So I think in general, I just realized while doing a little bit of homework on this topic that I've finished 56 quarters in this market. And it kind of gave me a little bit of a weird feeling because I was like, hey, am I too old now? Because 56 quarters is a very, very long time. 14 years. So that was one. And the beauty of it is that the 14 years have been spread across several dimensions, which all have a very different approach of looking towards looking at companies, looking at investing and looking at quarterly results. So the first couple of years I spent in a financial media house, which is very similar to what you guys do, but 14 years back, so no videos. It was mostly blogs and online content that I was scrambling out. Then a few years on the institutional broking side, which is mainly the sell side. After that, the buy side for a couple of years, which is fund management. And now it's a mix of fund management as well as a managerial role because it involves building and managing a business now. So I think you're right about, I don't know if I'm the best guy to do this, but I've got at least 4 different perspectives of looking at this. So it may be good, it may be dilutive. We'll see how it goes. But yeah, so in general, most of my time has been on the sell side at places like Antique Stockbroking, Motilal Oswal. And I feel a lot of the processes and systems come alive when you start working with an MNC as well, which is where the career at Daiwa Asset Management helped quite a bit. So it's a Japanese mutual fund investing over $200 billion globally. So that exposure brings in a lot of systematic approaches to things that you otherwise form mental models around and don't really document. And that's what happened when you threw this topic at me. I was like immediately devising a framework on how to go about this, which is not what I would have done earlier. It would have been a little ad hoc process with a mental model form, but now it's much more structured and approach.
That's good to hear. And honestly, that context is also very important because when we talk about, looking at quarterly results, since you've been in the wealth industry across different spectrum and across different roles, how you look at quarterly results also differs. Being a sell side guy is very different than being a buy side guy. And for somebody like us who's working, in the financial journalism end of things, we're trying to make life simpler for our readers, trying to help them understand one piece at a time. We'll have a very different take at how we look at results. How do you look at quarterly results across all these spectrums? And which one do you think is most relevant for somebody like me who is not a stock picker but still wants to be on top of what's happening in the business and finance world? And then eventually we can drill down from it.
So I'll compare sell side and buy side first, because those seem to be the most relevant when it comes to any investing decisions that happen at a large scale. Right? So on the sell side, you're going deep down. You're digging absolutely deep, every single detail to the decimal, with an objective of forming a view that assists the buy side in order to make decisions. So sell side reports, we have to understand, are made from a context that how do I help fund managers come to a better decision. They're also made from an angle to stand out.
Okay.
Because there would be in India, about 40 to 50 different analysts covering the same sectors and the same stocks. And you've got a set of relevant fund managers on the other side, and relevant being who's large. Because if they are large, they will give you more business if they like your work. So there's the same set of people trying to please the same set of people. And how do you differentiate? Because it's the same company. So you also have to start thinking about having a view that may be contrarian, having a view that speaks louder, having a view that catches someone's attention, and also being right at the same time. So it's a hard mix to get. So unlike a lot of people think about analyst jobs, I feel the sell side analyst job is a good mix between research and sales. The best research guy often is not the most successful one because he may not be heard, because his view is not, his writing may not be great, his speaking may not be great, his pitch may not be the best. The best sales guy will not be the best researcher, but may also be equally successful. So according to me, landing somewhere in the middle is important. That apart, what do you do while these reports, how do you analyze these reports, or what does the sell side guy do? He'll go down into the deepest detail, put out a 20-page report for every quarter. And that does not really is not really comprehensive at all times, because the context is isolation. For a buy side guy, he has to look at the company from the angle of how does it fit in my portfolio? Do I already have the stock or do I not have the stock? Is my other portfolio doing well at this point or not? So if a company, for example, is going to do badly for the next 2 quarters, whether the buy side guy or the fund manager is going to be patient with that holding or not depends also on the rest of the performance. So if my fund overall is doing good, I think I have some amount of leeway to let a fund stock do badly for another 2 quarters, which is not the same with another fund manager who's overall in a very tight situation. Sell-side reports usually miss this entire context, and you can't personalize it for every fund manager. So your single report has to sort of be as detailed as possible, and the buy side will take what is relevant for them from it. So it differs vastly in terms of how we look at these numbers.
Will that mean that because the sell side guys go really deep into a thing, may not have the context of what's relevant for each individual fund manager, is it better for a general finance reader to have a buy side guy's lens when they're approaching quarterly results? Because that general business reader could be somebody who's, let's say, building in the, ethanol space. And maybe Raj Industries' quarterly result at the very core profit level not be as relevant, but that eventually gets into the context of how he's trying to plan out his business. I am assuming it's more relevant for a general business reader to have a buy side guy's lens towards quarterly results. Or do you differ?
I think from a learning perspective, it's best to read sell-side reports because of the amount of detail that you get. What you draw out of it, as you said, if it's a business guy trying to read into it, his context will be completely different compared to a buy side. So I think the good start point for any, at least the viewers that you've got, for example, who's trying to learn about a certain stock, would be an initiating coverage of the company, which a sell-side guy would write in great detail. But from a quarterly basis, reading into sell-side reports seems to be a little bit of a futile exercise after you've become familiar with the company. Because the amount of incremental value addition from quarter to quarter is just too little. in most cases. So from that angle, I feel like it becomes a futile exercise afterwards, reading through 50 pages of just a lot of noise.
Next question I had, which was, I like to believe I'm a long-term investor, even though I don't do individual stock picking. If I'm a long-term investor, should quarterly results even matter to me? That's the question I had because, okay, I love reading about what's happening each quarter in a company, right? Let's say we talk about quick commerce, cement, all of that. Is that even relevant for somebody like me who's really a long-term investor? Because I remember reading a note that you'd shared with me where you said that these are smaller bits in the larger film. And that really resonated with me. If you could, maybe double down on that, explain a bit what you have in mind so that I am more sold on the fact that, okay, even if I'm a long-term investor, still going through those quarter results does add to that context for me as somebody who's just into business and finance.
I think it depends on what you're investing in and when you have invested. And I'll break it down for you. There are some stocks which are cyclical in nature, some industries which are cyclical. These cyclical stocks, unless they have a structural story as well, will always go in waves, will go up and down over cycles which are as short as 2 weeks, as long as maybe 3 years. If you hold that kind of a stock for a period of 7 years, you'll probably not end up making as much money as trading that cycle. So the efficient way to invest in, even if you're a long-term investor in cyclical stocks, is to play those cycles because they offer very large deviations between two cycles. You don't necessarily look at that and say, okay, I'm a long-term investor, I'm going to invest in a steel company and not look at it for the next 7 years. I'd say that's a bad idea. You'd rather be on top of it every single quarter, judge where the cycle is going, and judge where you are in the cycle and whether you want to be in the cycle or not and for how long. So that's about the cyclical bit. On the structural front, I would look at when I am investing. I would not look into quarterly results too much if the story is already playing out and I'm riding the wave already. So my check in such cases will be to see whether the quarterly numbers are making a large deviation to my thesis or not. And in most cases, when the story is sort of playing out, imagine the period where DMart was doing well for 5 years straight. Titan was doing well for 7 years straight. Or those kind of stories, HDFC Bank for whatever amount of time, Asian Paints for the longest time. You wouldn't get too much out of the quarterly results. What are you going to get out of it? Every quarter they are posting a 30% growth. For HDFC, their NPAs are under control. Everything, the headline numbers look great, right? Even if there is minor deviation in those numbers, the market is not really punishing it too much because they have a credibility of delivering. And the market has recognized that this is a long-term trend unless something starts falling off the cliff. That's when I would probably start paying more attention to quarterly results. In the case of some companies where the structure is not established, say for example, Deepak Knight, right, was a mid-cap stock at a point in time, may still be. So they were operating one single business and they were putting up a phenol capacity which would practically double their revenue. Now that was a large capacity initiative, a completely new business where they didn't have any experience, although it was same chemicals, but a different area altogether, right? And that is a structural change. If I'm playing that structural change, it depends on when I'm investing. If I'm investing very, very early on, I'm going to track every single quarter stringently because I want to know where the story is heading. I want to know whether the plant is commissioned. Has it come up? What is the utilization level? What outages are they facing? Are there any teething issues? Is the plant getting orders? What is the capacity utilization? Is the pricing favorable? Everything. I want to know everything every single quarter. If I have invested early enough, that will determine two things. Number one, my conviction will be challenged every single quarter. It will either go upwards or downwards or remain the same. Second, my sizing will make a difference. So as a buyer, maybe initially before this entire wave starts, just at the announcement, I may take a position that is 1% of my portfolio. As soon as the plant comes in, I'll probably increase that to 5% if it's come in without issues. If the capacity utilization is going and the ramp is happening as planned, I'll probably increase that position further. So my sizing decisions as well as my decision whether to invest or not, how much patience to show, what to expect in terms of returns is very dependent on every single quarter. So I'll be supremely careful of those things. Even in established stories, when there is a major change in the thesis, I want to know if that change is temporary or whether it is more permanent in nature. Like Asian Paints, when Birla Opus came into the picture, I think I want to track every quarter at that point in time because I want to see how that story is playing out. Quick commerce affecting retail, I want to track every quarter. So I think it really depends on what you're invested in. That will determine the frequency of you tracking it. So when I was tracking the IT sector, for example, this was between 2013 to 2018. I don't think much was happening at that time. At least till 15, 16, there was not much happening. Things were pretty quarter on quarter. They'll do 2%, someone else will do 3%, and it was honestly boring. There was nothing to do with it except for tracking whether the number is pretty much there or not. However, when things changed, which is when initially there was a wave of, they used to call it SMAC, Social Mobility Analytics Cloud, which then got renamed to digital. So like AI is a threat wave right now, digital was a threat wave saying that Indian IT companies do a lot of ERP implementation, ADM, deal sizes are getting smaller, the new technologies, stuff like that. It will threaten the entire model. At that time, every quarter was necessary because you're getting to know which companies are acquiring what is their qualitative strategy, where are they investing, how much percentage of the revenue is coming from new services, and all of these details you would get in quarterly numbers. And of course, you validate that against the financial statements and whether the company is actually growing or not. So during that wave, I feel again, quarterly results become important. And as soon as that wave settled and things came back to normal, we were like, okay, now it doesn't matter. It's getting boring again.
I think I can relate to that a lot because for the longest time, like you gave Paints example, up until Birla came in, although Paints was one of the first sectors that I started my equity research journey on, I found that to be boring. But ever since these guys came in, it's always too exciting to read through chronicles of Berger, Asian, how they are reacting to what Birla is doing. Same thing, I guess, happened with microfinance. Over the past couple of quarters, we've seen the microfinance cycle sort of turn. All of the bad ones are behind. And it is during these cycles, looking very closely at all of these sectoral results actually does help a lot. If you're an investor or you're not, regardless, it's always just good to see the track of the business. But in relatively stabler stories, it does get boring. And I've seen that happen for a couple of stories we did as well. But every now and then you see all these sectors have these micro trends come up. And it's always good to be on top of it. And quarterly results, I also think, are the best way to do that.
No, but also going back to your sell side versus buy side, right? Sell side does not really have an option but to track all of these boring quarters as well. So they have to dig down deep, make detailed notes, update thesis, all of that. But I think as a buy side guy, as a fund manager, I would probably just look at some of these stories and be like, do I even care about this result? I don't, it's going to be a non-event, move on. So I'd probably just briefly read a couple of sell-side reports, just two lines of what they're saying and why they're saying, get a few different views in, see if it's changing my thesis at all, and swipe, move to the next. So the amount of time I would spend as an analyst on the other side would be allocated depending on what story I'm playing where and which sector it is, which also coincides with where you are on the learning curve. So I feel like quarterly results are a great way for someone to pick up a new company and learn about it. Also because it gives you material fresh. There is context and relevance. You're not living in the past or the future. You're sort of there at this point in time. You're getting familiarized. There are con calls which you can attend where people ask basic questions as well as tough questions both. So it's a good way to familiarize yourself with what is happening. So I would also end up spending a lot of time on quarterly results of companies that I've just started tracking or sectors that I'm new to.
So what does this process look like? Again, I know that you're no more even on the buy side, you're more an operator now.
Yeah.
But your last stint as a buy side. And I guess that's something that I would relate to as a general finance reader. I wouldn't want to go deeper into this, how sell side does things, because these guys are insanely smart, super on top of almost everything happening in the sector. I don't think that's very relevant for a general business reader. I'd skip that for now, at least for this conversation. If you're a buy side guy, you're going through quarter results. What does that process look like? I know every quarter we have these chronicles happening. Investor presentation IV, we'll have these financial numbers come in. When all of these come in, what's your first step? What's the pre-game, during, even after? Well, how do you prep up for the quarterly season? What happens during the season? How are you doing it company by company or maybe as a whole sector? And then what happens after it? How do you update your mental models? How do you update your observation? Just walk me through briefly as to what does that look like for a buy-side guy.
So I think we'll have to take a step back and look at how a buy-side guy is in a very simplistic ideal situation looking at portfolio building and relate that to the quarterly results.
Okay.
Right? So if I'm managing a fund, which is say, it's an India fund, diversified. My only objective is to beat the benchmark by as much as possible. How do I beat the benchmark by as much as possible? By deviating from the benchmark, which is taking active calls on my portfolio versus the benchmark, and by how extreme those calls are and how right I am in those extreme calls. Simple formula. So then I'm looking at, and it's a competition, right? I'm competing against the benchmark, non-living, but sure. So I need to know my benchmark well. So I've seen what sectors are part of the benchmark, and I have to take an active or a active call on either direction or remain neutral if I'm not convinced of either direction. So I'll take those active calls on sectors, and within sectors I'll play sub themes, and within those sub themes I'll have companies that I pick out, and that's how I'll sort of build a portfolio. I mean, very theoretical, very idealistic, right? Doesn't actually work that way too often, but sure. In this process now, there are a lot of companies where the quarterly result won't even make a difference, right? So I'll eliminate those. For example, there was a period between 2018 and 22, for example, where Jio had come into the telecom space. Just about entering, became a three-player market with Jio, Airtel and Vodafone. If I had to beat any telecom index or the benchmark at that point in time, the easiest thing to do was Jio is not something I can play. Vodafone is a short and Airtel is a long. So I would go heavily overweight Airtel and heavily underweight Vodafone. And I'll stick to that. And I think that is still relevant, right? So no matter how many quarters pass by, it doesn't make a difference. That is something I just park aside. I say I will easily, comfortably beat my benchmark using this little action. Or simply put, if I have to say, for example, pick out an info edge, which is part of a media telecom index, but it will, no matter what, beat telecom companies. So let the telecom companies fight it out. I am safer playing info edge, which is an internet company, nothing to do with all this. Still part of benchmark. I will beat the benchmark anyway. Quarterly results do not matter. So I'll start looking at quarterly results which matter. Now, what do I do in those? I have very basic financial models made for each of these companies. And they're not detailed financial models like that of the sell side. So I'm not making very detailed models which talk to every single statement and to enter 100 numbers and gives you an exact output. And the file is some ridiculous, a few hundred MB large. That's not what I'm doing. I'm making a very back of the envelope sort of situation, which fits in just one single view page on my Excel. It has all the relevant details and it gives me a certain output. Now that mental model, I will go through once on the day or before the day of the result. So I want to make sure what my thesis is. I want to see what numbers are translating into what output. And what am I trying to gauge here? Ultimately, whatever the inputs be, I have to gauge two things very simplistically. One is earnings and one is the valuation. So every quarterly result, what I want to seek is how do the quarterly results change my earnings and how do they change my valuation? As simple as that. Now, what are the relevant metrics that come in that I need to input that will make the difference? What are those relevant metrics? I will sort of keep a track of or I will sort of revise before the result comes in. And I will also look at the sensitivity of those metrics to both the earnings and valuations as well as my thesis. So if I'm investing in a company which, say, for example, has a very large capacity coming in, now the future of it, the earnings as well as the valuation will depend on this capacity. Because let's say this capacity is coming into something which is an adjacency to what they do. And this adjacency is more value added. So value addition is going to be high and hence customers are going to be stickier, revenue per unit is going to be larger. So it generally places the company at a much higher pedestal compared to where it is right now. So it deserves a better valuation. And the product, say for example, is something which is in a high growth, high emerging area. Now before the quarter, I know that this is what makes a difference in my thesis and I have to track this. On the day of the result, what I'm doing is I will initially open the investor presentation. It gives me relevant information and calculations ready. It matches my model because there is a way the company or the management looks at the business and I want to sync it with that. There is no point in the management saying or viewing the business from one angle, me having my own way of looking at things and then having to scramble it up together. So I'll try to sync it. So the investor presentation and the deck will give me all the relevant data, the segmental information. It will tell me whether this business, how much they've invested, whether it is ramping, not ramping, if there is revenue coming in already, how much. All of those details I'll get quickly from there. So I get a sense of what is happening. Once I've got a sense of that, I want to ensure that there is evidence of that happening in the actual numbers. So for example, if say this plant has already come into play and they're claiming that revenue is coming in from this business, if pricing is higher there, I will dissect the revenue into volume and pricing and ensure that the pricing has to increase. Because if the pricing is not increased, there is a discrepancy somewhere, which I want to check. Second thing I'll do is probably look at margins. And margins may not rise up because maybe it's in investment mode, right? So is pricing increasing and still margin not increasing? If not, what is the quantum? What is the quantum and does it add up to what the management is saying or to the amount of investment they're making? So say the plant is already invested 2 quarters back, capacity utilization is at 60%, but the expenses do not really say that. Say for example, the expenses are commensurate to the capacity utilization being 25%. There is a problem. So I want to look at the qualitative data, start relating it to the numbers and find out whether it is giving me evidence or is it causing some discrepancy. As soon as I've done that, I know what to look for in my next step, which is the con call. So whatever discrepancies arise, I will then go to the management and sort of ask for details, or I'll let others ask and just listen in, but I'll get feedback from there. And that is when the entire thing ties up for me as an end result. All of this will make me tweak my numbers. So that one basic model that I had made, I will tweak those numbers in and then figure out how my earnings is changing or my valuation is changing. Say for example, the plant is delayed. So my earnings trajectory gets pushed a little forward. My earnings estimate goes a little lower. Because the growth does not come in, the valuation will also probably come lower because the market is not going to reward it with the same valuation as it did earlier, which is also not necessary. Say for example, the investors never believed the management and that is already discounted. That won't happen then. So I will make an adjustment to both my earnings as well as valuations and then figure out what my target is coming to. Why does that matter? I know exactly how much of a return I'm playing for over what duration. And I will start to gauge that against some of my other bets. So a stock is likely to give me 20% return in the next 1 year. It was likely to. After the result, it's likely to give me probably 10%. It changes my outlook on whether I should hold the stock longer or not, or double down on it, or cut it, or let it be. So because there is an opportunity cost associated with me not earning that 10%. And the underlying context again is how badly or good is my other investment doing. So if my overall investments are doing amazingly well, probably I'll show a little more patience towards this. If they are not, I won't be forgiving at all. So I will go back to contextualizing the outcome of this result with my other holdings and then taking a decision, which is essentially 5 steps, right? Buy, add, do nothing, reduce, sell. What do I do?
So the core of it was you started with an end in mind because you already had the context. Okay, you gave the example of that plant coming. But is it always that whenever you're going head on, reading at quarterly results, you always have that in mind, that one specific, a couple of things you're looking for? Or are you open to being surprised by anything new that comes in? What does that mix look like? And also, if let's say you already are invested, so you already have that context for the company, for the sector, all of that. How does this process change if you're talking about a sector or a company that you never looked at ever again? Does this change for you? I'm assuming it does. And if it does, how much?
I think surprises don't come as often. I think they do come in. They can be positive, negative. They do come in. I still remember one of the companies that I was tracking, KPIT. I had initiated coverage on it long back, right? 2014 or 15, sometime during that time. And the first quarter after I initiated coverage of it, I think my report had some ridiculous 35-40% upside, right? It was a buy. The first quarter happens after that. And there's an IT company, okay? As an IT company, it has reported a single-digit EBITDA margin. Unheard of. 4.5% EBITDA margin for an IT company from 15 or whatever, 15%. They've 1,000 bips decline. And I had no idea what to do. That's a surprise. No one saw it coming. They were full of one-offs and reasons and excuses and all of that. And the fall in the stock has been, again, 30-40% the stock has fallen. And I'm like, my career is over. As soon as it starts, my career is over, was my first thought. So you do get surprised on the negative at times. You do get positively surprised at times also because there is a beat compared to what you are baking into your numbers. You can't predict those, right? But how much are those chances? I don't think there's too much of a chance of that happening. I can't put a number to it, but it rarely happens. In the sense, I mean, it happens less. That there is there's something that you don't know that comes up. There may be announcements on the business side which may come up, which is an acquisition, for example, announced, which may be an unrelated area or which may be perfectly synergetic. There may be capital allocation decisions which may bother you. Those are surprises on either side that come in. Exceptional dividends or buybacks. Sometimes just saying that dividends, buybacks, that kind of stuff. But nothing else other than that. Usually it's not. And I think, I'm looking at it from a slightly longer duration now from the buy side perspective, right? Because otherwise, from a sell side perspective, it can be a beat or that's what you keep hearing. It's a beat, it's a miss. But those are a few numbers here and there. I don't know how much of a difference it makes for a slightly long-term investor. It's all noise. So for a company, for example, which I'm investing for a 3-year period, and I know that there is a certain story I'm playing. There are 2 investments that a company is making. I'll give you an example, like Acuta's Chemicals, which was Ami Organics. They are investing in 2 new businesses, which is one is to do with semiconductor chemicals. The other one is battery chemicals. I'm playing the story. I want to see how those numbers pan out in terms of capacity, orders, revenue from it at a meaningful level. And I know I'm playing a 3-year story there. If in that something happens, which is a temporary blip for a quarter, how much attention do I even pay to it? So it may be a surprise on either side. If it is a surprise that is negative and the market punishes for it, I may look at it as an opportunity being a 3-year investor. Because I'm like, hey, my 3-year thesis remains intact. I want to buy into this. So the investment decision will also depend on how the market is treating that surprise. So more often than not, I feel like results do throw out surprises. However, they have to be looked at as opportunities in terms of whether you can act on them. So they may not be surprises for you from a thesis perspective, but they may pose opportunities for you to buy or sell or take some decision to optimize your return.
The second question was, when you're looking at a business which you've already tracked for a while, this is how you go through it, but it is a new business altogether. What's the frame of mind you go in when you're reading that quarterly result? Are you like completely open-minded? I don't know what to expect. Or do you still have some things in mind? Okay, am I still optimizing for my portfolio? What does that look like?
I think for a new company, I would always do my homework before hopping onto a call and sort of trying to decide something on a call. So quarterly results and con calls become part of the research process before you make an investment. Ideally, then research it by whatever, right? Looking at initiating coverages, speaking to a few people, speaking to management, visiting plants, looking at the industry, all of that jazz. And quarterly results would form a part of that. So I don't think I've entered a company's result and said, hey, I don't have context here. I think it is absolutely pointless walking into a call without context and going like, okay, I'm going to learn the company by being on the call. I feel like it's better to do homework and have quarterlies as a part of that homework rather than treat quarterlies as a starting point for learning. It's as actually poor as not having expectations, right? Like, for example, you read a result, you say 20% up, it's good. But good against what? Good against, if you don't have an idea of that, it is pointless reading into this. So as much as that, it is pointless walking into a con call without knowing what is happening.
So this is a good segue into me asking you, every time I go to an analyst or talk to an analyst, the center of everything that we do is expectations. What is the large street saying? What are consensus estimates? Why do these expectations matter a lot to you as a buy side or a sell side guy? I mean, I partially know the answer, but I still want to hear it from you so that I'm better able to understand. Why do these matter a lot to you? Why can't you be just happy knowing the business and making an investment? Why do you want to know the expectations?
The price is nothing but a cumulative of expectations. So I feel like out of the 2 components of a target price, right? Earnings and valuations. Earnings is the easier one. Valuations is the harder one. And valuations are they feel arbitrary in the beginning. They feel arbitrary in the sense that I feel the stock is trading at, I know the stock is trading at 20 times. I feel it should trade at 30 times. It's very arbitrary. Till you actually start cracking it. And how do you crack it? You start understanding what the consensus expectation around or the consensus ability to pay something for a stock is. And what do I mean by consensus here? Everybody in the market. Because demand supply will effectively drive the price, right? So what is collective psychology telling me about how much a stock is currently valued and how much it will be valued? And according to me, I may think it should be valued at 30 times. But there may be a situation where you may also feel that I feel the market will not understand this and the market will price it at 25 times. And hence me expecting 30 times is absolutely futile. So to simplify it, I always want to know what expectations are. Is the price reflecting that expectation? How is it different from my expectation? And then reconcile all these things and then come to an opinion on what to do with it. So expectations become pretty much the center stage when we're talking about taking any decision around the price of a stock.
Is that a good leading indicator of what's about to happen in a sector or an economy? Or is it just tied to the financial markets and have no bearing on the real world? Or am I oversimplifying?
They can, they cannot. So they say the market is always right. It is not true. It is sometimes not right because the market is not fully pricing something in. The market can be overly pessimistic about things. The market can be overly optimistic about something. So I feel like as much importance as you pay to what the consensus expectation is that is baked into a price, you need to have your own opinion as well. And a combination of what your opinion is, what the expectation is, will drive what you do with it. And I'll simplify this again for you. So for example, talk about the EPS. The expectation is 100. That's the consensus expectation, right? And consensus, I mean the cumulative of all the sell side analysts put together.
It's an average.
An average.
Is it a weighted average or literally an arithmetic?
It's a literal arithmetic average, which does not count number of inputs that are going in or the dispersion of it. So it can be a pretty misleading one. For a thinly covered stock, there may be two analysts saying two extreme numbers and it will take the weighted average, not weighted average, it will take the mean. For a stock that is covered by 20 analysts, it will have a very thin range and you'll be at the center of that. So it can be narrow or wide depending on the amount of coverage. But I would sort of say 100 is what the consensus EPS is at this point in time. I am expecting say 110, right? And the company delivers 120. I think it's a happy situation for everybody. So nothing to do. If the company actually delivered between 100 and 110, then it's lower than my expectations, but it's still higher than market. So I may change my thesis, but the stock's reaction may still be positive. So I think the context changes every time you try to place these three numbers in various permutations and combinations. So are you in the center of market and actual? Are you on the left? Are you on the right? Or whatever combination? That will determine how the price moves and what you do at that price moment. So I think we'll have to form a 9-grid sort of matrix to exactly pinpoint on what decision you're taking.
How I'm understanding it is that I have my own version of truth. Not truth, but I have my own version of read on what I expect. Yeah. Then there's the market's version of it. And then there's the actual absolute truth which does come out in the market, which is actually happening. And investing is all about playing in the middle of it, trying to make sense and converting on the opportunities that show up. Is that right way to look at it?
Not completely. I would kind of, again, we can go back to that Deepak Nitrite example, right? When they were putting in the phenol capacity, for example, the actuals didn't show the number till till the capacity actually came in. As an investor, I would start building in those numbers into my model. The numbers built in are on very little information. Like me, several people are building their expectations in. In the beginning, everybody's expectations will vary vastly because there is very little information available about what is happening. In such a situation, I'm not trying to form a average between the three or playing the stock or my decision as a cumulative of the three. What I'm trying to figure out is, one, how right am I going? And while I'm going right or wrong, how right or wrong is the market also going? So, for example, if the numbers start coming in 2 quarters later, right? In my numbers, market is expecting say 3 or 4 quarters later. How do I know the market is expecting 3 or 4 quarters later, by the way, that the valuation has not moved up? So the valuation is still it's still trading at say 10 times 2-year forward earnings. According to me, it is trading at 6 times earnings because my earnings are bloated, right? Because I'm expecting something to happen faster. The company ends up delivering that 1 quarter in the next quarter rather than 2 quarters ahead. The actual is that the company is trading at 4 times. So I would, in fact, at that point in time, sort of double down on my decision, add in more weight and play it at a much larger effect, because while the earnings are also going up, the multiple will also go up fast because the market will start realizing that, hey, the story is playing out. Growth is coming in exponentially. New product, new territory altogether. So it will take the valuation from 10 times to 30 times over a period of time. And I want to write that entire way. So it will not be necessarily at all points in time trying to reconcile everything and be in the middle of it. But it will at a lot of times be taking advantage of the asymmetry or your knowledge or your judgment, and hence playing that and buying into it.
So at the start of the conversation, you mentioned how being a buy-side guy, you don't look at things in isolation. You have a lot of context, your own context. Okay, what does my portfolio look like, right? And I think that's really relevant for a general business leader also. कि maybe they're IT professional or उनका अपना business है. They have that context in mind, and whenever they're going through business news and finance news, they have that context in mind, and they're using this, they're consuming all of this business content in service of that. And that is also why whenever we do a lot of quarterly result stories, we always club them in a manner where we're trying to understand a sector in general. Because maybe then we'll be of more service to folks who just read business and finance news as a consumer of content and not really, typical stock analyst. A lot of our content is not in service of those guys because we know वहाँ पे sell side guys are doing a much better job than we'll ever do. That said, when we are looking at sector results, right? We look at, I walk you through our process. We look at 3-4 companies. हमने उनकी कॉन कॉल्स पकड़ी, हमने उनके रिजल्ट्स देखे, trying to draw some parallels. We have very little time. What we're trying to do, पहले हमने कोई स्टोरी की थी, उसमें if there was something that stood out, we try to see whether that played out eventually. What's the progress there? Is it improving? Is it improving? Margins, very basic check. And then also over the past quarter, if there are any new announcements, acquisitions, all of that, and putting all of that context. This is how we serve the purpose of our audience. When you're a buy-side guy and you're not looking at just one stock, one company, you're looking at the whole sector. What is your way of looking at things? And now I say it not just a very company specific. I don't want a very company specific answer, but more a sector specific answer. How do you do that?
So generally, I feel like it's about identifying. I think you oversimplify sectors. Within a sector, there are multiple subsectors or themes playing out. And I feel it's, at least from my angle, I have a sort of method of going about it where I'll dissect and divide every sector into subsectors. And I'll try to see where I'm positive on.
You divide them basis what?
It will differ. So for IT, for example, I'll divide it across your general IT services, products, domestic, hardware. When it comes to FMCG, I would probably divide it as, again, there is direct consumer, there is retail, there is, if I'm looking at the broader consumer term, there'll also be auto within it. Or let's forget that consumer term, it's too broad. Let's take auto. Within that, I'll have 4-wheeler, 2-wheeler, maybe 3-wheeler. I'll have auto components. Auto components also, what am I playing within? In chemicals, I'll have a sodium play, fluorine, chlorine, nitrogen, various chemical element chains, or something that is diversified, or something that is completely not relevant to all of this. So I think it's important to first understand what you're dividing the sector as. It will differ across sectors, how you're dividing it. Metals will be simple: steel, aluminium, zinc, copper, whatever. Cement, I would divide as geography. So what is pan-India, what is north, what is west, east, center, south. So regional versus pan-India. Then I try to probably club those together and then contextualize what trends are coming up. How a company will deliver if it's in 4-wheelers versus 2-wheelers versus auto ancillaries will vastly differ. And the proportion of business within those as well. So I think the first step is to start putting sectors into subsectors. Club companies into those subsectors, analyze them together as small pockets, and then figure out what is moving in what direction.
I find that slightly problematic. It just becomes too complex then. Then it becomes towards the even point of having sectors because, okay, let's say auto. Auto is a very bit wrong way to look at it. Let's look at 4-wheelers also doesn't do justice because then we have players like Maruti which didn't enter EV up until very recently, and then we have Mahindra. Mahindra Auto itself is not listed separately. It's part of the larger Mahindra group, if I'm not wrong. How do I make sense of all of this? Because then all of these overlaps come in and the permutation and combination are actually much larger than the largest stock universe only. We have more than 4,000 permutation combination. Then again, this is a very selfish question I have. हम तो एक sector को cover करना चाह रहे हैं. But if we start looking at all of these complications, I know there are a lot of caveats. Whenever we do these sector analysis, there are a lot of these caveats. We won't be able to do full justice. But then we're just left in the rack where at one point we want to make sure that we're giving a good story, but at the same time, we know for a fact the classifications that we've done, they're just not right. Isn't that way too problematic? And then how do you, as an analyst, look at it? Because in that case, no two companies will ever be the same. And what's the even point of mapping it on a sector?
They'll nod, and I have an answer to that, to be honest, in a completely different sector. Let's look at aluminium as a play. Okay. Now, you would probably think that aluminium companies will be pretty similar because it's a commodity. It's simpler in commodities because there is a raw material, you are processing it, you are giving it out. Turns out it's not, right? And we looked at this play when the entire strait was closed, and we realized that aluminium as a play seems nice because one of the major facilities in West Asia was bombed. So the aluminium plant shut down. Now, when an aluminium plant shuts down, it takes a couple of years for it to revive. You can't just switch on, switch off aluminium plants.
You're talking about the miners or you're talking about the
Refiners. So alumina or bauxite or whatever, it doesn't come directly, it's not produced in West Asia. It actually comes into West Asia. It is refined over there. Because a lot of heat is required, the majority cost on aluminium refining is actually heat. And because there is a lot of heat sources or energy sources available in West Asia, that becomes an advantage that these guys have. And hence a lot of aluminium refining happens in that region. When a plant shuts down, you can't restart it. It takes a couple of years, and hence there is a supply deficit that happens in the globe, because of which low-cost producers benefit because they're able to increase pricing as well as push volume out. So the theory was that Indian players in the aluminium space will do really well. So we looked at what are the options do we have, right? We've got Hindalco and we've got Vedanta. How does it make a difference here? Because, and that's where caveats come in, right? What will happen is the raw material price is going to be same for both.
Okay. Yeah.
I'll talk about the generalization first, which is the geopolitical situation is same for both. The demand supply dynamics are going to be same for both. The raw material price is going to be same for both. The energy cost is going to be same for both. The end product cost is going to be same for both. Generalized, you can club them into the same industry. Now, both these companies are vastly different because when it comes to the stock, Hindalco's got a domestic operation and it's got a subsidiary in the US. So Novelis is the US subsidiary. What happens in Novelis is that they don't refine it by taking the raw material. They instead buy scrap, refurbish the scrap, and then supply to high-end automotives, aerospace, beverage cans, low and high-end usages. In such a situation where there is a supply crunch, scrap prices also go up. So ultimately, Novelis does not really benefit out of the entire thing because they're paying high for raw material. And on the end consumer part, which is auto companies, beverage companies, etc., they have long-term contracts. So they actually get squeezed. So the margins on Novelis get negatively impacted. Whereas the domestic business where they're taking bauxite or alumina and then processing it and then making aluminium, that benefits. So you have one negative part, one positive part. Then you come to Vedanta. Before its entire demerger and whatever, there was 5 different things that the company was doing with aluminium just being a part of it. In this situation also, if I have to compare the domestic businesses of the two, one has more backward integration, one has lesser backward integration. One has more captive power, one has lesser captive power. So there's always going to be differences. So in general, what I want to get at is that the broader commonalities or the general things that we spoke about have a certain useful dynamic that you can derive. Now, how relevant it is for who is something you have to disconnect from generalization for, and you have to become specific. So I would rely on the broader alumina trade and the sectoral things that we spoke about. And I'd say that, yes, I derived all of that from the con calls and the results and everything. But how I play that into a decision will need some amount of, actually a large amount of going into specifics and then making a decision, which will be true for everything, including your four-wheeler market, where I may say that India structurally is seeing more four-wheeler growth, is seeing higher EV penetration, has an affinity for SUVs. These are all trends which are common across. Who is playing it and well becomes an investment decision. So from a sector standpoint, I feel like if you're there for learning about what is happening in the sector, I think it's great to club companies together as broad sectors or as subsectors and get trends out of it. If you're taking investment decisions, there is no option but to become specific.
Does it also mean that because all of these companies are unique at their own end, if some common things stand out across, then that trend has a much higher cyclical to noise ratio or not? Okay, let's just talk about SUVs only. If there are players whose SUV portfolio is a larger chunk. And then there are players who do a lot of business in sedan and hatchback. But if both of them end up talking about SUVs growing, then that trend sort of becomes thing to look out for throughout the sector. Why do I say this? Because across the companies, all of them will have different stakes because they are different in their own way. But at the same time, all of them are pointing in the same direction. Or am I overreading into it?
So I think that is a very relevant trend. And I feel there is also a trend where, for example, one company will say, oh, we don't see this happening.
Yeah, precisely.
So, and there you know that either the company is not participating in it or they're covering their tracks or they just plain simple diverting attention to some other place. And that happens surprisingly all the time. So IT services, great example again. Most of the businesses are very sort of, they're fighting for the same deals. They're in the same market. One company will say that business is looking very good. The other one will say the market is soft. And you have to reconcile it. And the only way to reconcile it is by reading a sector trend and then figuring out where the discrepancy is. So the problem may not really be demand in a lot of places. The problem may be the supply. And by supply, I don't mean supply of raw material, etc., etc. It may be strategic supply. It may be directional supply. So I feel like it is very relevant to understand overall trends and then even figure out where the discrepancies are and why. So is it execution lapses that the management is seeing, which is leading them to say that, oh, this is not important for us or we don't, whatever, right? So it's very easy to catch these things once you start reading into sectors. You are able to actually catch them in a manner.
Talking about catching managements, one thing when I started my journey of equity research, I learned was that a lot of these times going through these con calls, they're a gold mine of information because you have CXOs and operators of these multinational corporations, very large businesses in India, talking about their business and giving us a read into how the economy is doing. It all feels really good to listen to. Let's say, we have Uday Kotak talking about banking. He knows a thing or two because he's been doing this for 20, 30 years, even longer. And if I want to learn something about banking, I would want to listen to what he's saying, what's his team. All of that makes sense. But at the same time, we also know that not everything that they say should be taken at face value. A lot of these times we'll have managements not delivering what they promised or just simply outright being very not so confident about what they're saying. So we'll have these managements not painting the right picture and we can see through them. Analysts can see through them. How does that process look like for you? Because again, for somebody like me who's just started, reading about businesses, reading through call calls, I'm a very naive guy. I would like to believe what they're saying is the truth at all times, which more often than not is not the case. For somebody who's gone through con calls for past 54 quarters, how do you see between what's right, what's not, and you can catch, okay, maybe what this guy is saying is not really 100% truth and there's got to be some catch here. How do you do that? Or is it just pure experience?
There is a couple of ways of doing it. One is certain managements have a tone, which is like how you judge a person's nature, right? That this person says X, but he'll do Y, for example. Every company management also has a tone. Infosys is a great example of always under promising and over delivering. Historically, earlier, like in the golden days of Infosys or whatever. So there have been times where, for example, the management indicates either numerically or qualitatively that, hey, we'll do, say, for example, 3% QOQ growth next quarter. Public in general doesn't treat that as 3. It reads it as 4. Because historically, they have said 3 and delivered 4. Now, even if the company delivers 3.5, the stock is going to get beaten a little, which is higher than management guidance, but it is lower than what collectively we think is the general understatement of the management. So it becomes tricky. It's not as easy as what they said and what they delivered. It's also what people perceive they said and what they actually delivered.
Sorry to cut you off. That would also mean that you would have been on top of what they've been saying for past couple of quarters and having a note of that. If there's somebody who's new, right, and who's let's say going through con calls for the very first couple of times, how do they make sense of that? Because I guess the only way out of this would be to go through con calls for those managements for the past 4, 8, 12 quarters to understand the tone. Is that the only way or is there a shortcut to it? Tell me a shortcut.
The way to go about it is numerical. Numbers don't lie. Right? At the end of the day, what is being said, what is being done, and the numbers that are delivered should be in line. If there is a mismatch in any of the three, as an investor, you will know. Today or later, you will know. If you don't have information on the first two, you have the third, and everybody has the third, which is the numbers that are delivered. I'll give you a couple of examples, right? Where, for example, a company, say we are entering a new year, FY27, we just entered. The management has said that we will deliver 25% YOY growth. So what you do then is the first quarter, they deliver, for example, rather than 25, they deliver 15%. And 25 is for the whole year, right? They deliver 15% YOY growth in the first quarter. Now the ask rate for the next 3 quarters is much larger. Now the management says that we are confident of still delivering it. What you can simply do is, whatever that 25% growth implies, you take that full number, you minus 1 quarter's number from it, you see what 9M is. You compare that 9M upon the last year's 9M and you see what is the implied growth. Now the implied growth will be much higher than 25%. Then you match it to a couple of things. One thing is the industry delivering enough opportunities to deliver that number? If the industry is not delivering an opportunity, but you're saying 50%, there's a problem. So you catch them there. Second, you start looking at peers. Are peers talking the same language? Then how can this one company grow? So that's the second. The third is you start looking at historically if they've delivered. Historically, has there been a 9-month period where they've delivered such growth? If yes, no, you'll get an answer. Fourth is to look at the capacity. Do they even have the capacity to deliver that kind of growth? And if they do add the capacity, will it translate into growth in the next 9 months? So I feel like you can evidence a lot of these using numbers and figure out whether what is happening is possible from a mathematical standpoint or not. If it is not and the management is saying yes, you know there is a discrepancy between them. And the same thing can happen. Let's not take growth as an example. Let's take investments as an example. Or growth and investments as a combination, right? So if the management is saying that, hey, the market is extremely good, we see X amount of growth happening, but they're cutting on pricing. If you dissect your revenue into volume and pricing and you see that they're getting very aggressive on pricing, is that growth healthy or not? If it's not translating into operating margins, it is problematic. If the management is saying that they're investing in growth, but the margins are still increasing and not really reflecting that growth. So for example, a lot of managements will say that we are investing aggressively in growth. That will mean either they're cutting pricing in order to grow, or they're hiring a lot of sales and marketing, or investing in sales and marketing. If the SG&A is not moving, then there is a problem there again, because what the management is saying and what is being delivered is not really adding up. So I feel like there is a lot of ways to check this, including checking YOY numbers, for example, or including checking a CQGR. So I would...
What's the CQGR?
So I would look at what did they deliver this quarter and 4 quarters back, like a CAGR, but for quarters. And then I would run a trend line on it to see if my CQGR is actually going up or down. So it's a good indicator of momentum.
Oh, okay.
Business momentum, not like investing momentum. So if the delivered CQGR is actually on a downward trend and they've delivered say 2% CQGR in the last 1 year, but the ask rate because of their guidance is say 4%, I know I have to dilute it further and that they won't achieve it. And the decision for me there also becomes that is the market factoring in the same thing? So if the market still believes the management, I would get out of the stock. If the market is not believing the management, it is already down, then I have some leeway because the stock will not really react negatively even if they don't deliver. There is quantitative backing at all times.
I think that still requires a lot of hard work. So we use this tool called Tijori in a lot of our process, and they have this thing called a con call monitor, where you get all these transcripts, which get transcribed live as the call is happening. And you have AI summaries, all of that. There's one feature that they built in this, which I really find fascinating. It's called management consistency. And what they do is, whatever are the observations from that con call, they corroborate it with what they said earlier, and then tell you if they are living up to that or not. So one observation that the feature in the tool showed me was credit growth expectations of private sector banks. I don't recall which bank was it.
Yeah.
But for past 3-4 quarters, it started off saying, okay, we'll achieve 18%. It got muted to 15 the next quarter, and then 11 to 12 the next quarter. I felt very happy to see, okay, I'm being investigative here, because a lot of what you're saying, corroborating what they are saying with the numbers, requires you to be that investigative guy who's trying to delve deeper. And tools like these, especially AI as well, helps you do that a lot easily. Something we'll get back to in the later end of the call. So Sagar, there have been times where we might, I would put a lot of emphasis on a change in a company, which
didn't warrant it. And I would overreact to that. Okay, I'm not an analyst or a stock picker whose view is having an effect on the price of the stock, but I would overreact to something that's happening in the company. And there are also times when I might underreact to something that's happening in that quarter. How do I differentiate okay, whatever's happening in that quarter particularly affects the business structurally, or is it still a one-time thing? How do I make sure that I'm putting the right emphasis and right weightage to that event happening during the quarter? Is it purely a function of how long have I been tracking the market, how much context I have, or there are other ways to do it as well?
I think it's simply bucketing, right? I think the exercise is pretty simple in terms of figuring out. I would put it into three buckets. One is what is exceptional or one time. Second is what is cyclical. And third is what is structural.
Okay.
So if there is a development happening in the company, which is say slightly long term in terms of a new investment they're making, that would be structural. If there is a pricing scenario or a demand scenario, that could be cyclical. If there is a disruption, that is one time, say factory caught fire, one time things would fall in that bucket.
So I have a question here. Is there a possibility? Now, I think there will be a possibility that there can be overlap. One example that comes to mind is, let's say, Birla Opus. So Birla Opus entering the paint industry. Would I call that a one-time? I could call that a one-time aberration where, let's say, for the next 4 quarters, they try to win market share from the incumbents, and then they just become another player in the industry. Or it could be a structural trend where they eventually do become the second largest player, which is something that they were saying in their calls. And even in terms of capacity, I think they've achieved that number as well. Or is it a cyclical thing where, okay, it's not just a one-time thing, but we see that happen for 2-3 years, but again, it's still huge now. My bucketing, I'm not so sure. How would I look at that event? How would you read that? I mean, I know I can be wrong, so can you.
Okay, there are two things here. I would look at, one is what is your definition of a cycle, right? Cycles can be very different. And the longer you elongate time, everything can fall into a cycle. The whole of humanity can fall into a cycle if you stretch time long enough. So one is you have to sort of figure it out in terms of what is your investment horizon, and hence is it structural in relation to your investment horizon or not. If my horizon is 5 years and the cycle is going to last 5 years, it is called structural, right? Because my time horizon is only that much. So one is contextualizing that. Second is, let's assume that a 3-year period is a cycle, right? For now, that we are super long investors, we are coffee can people and whatever, right? So we are saying that the cycle in terms of pricing will, because of elevated competition, prices will go lower. Volume share will be taken or shared more equally rather than it will become more fragmented and not so lopsided. And that at some point in time, it will settle, because at the end of it, it is a commodity and no player will be able to afford undercutting on pricing for a prolonged duration, like telecom. ARPU will rise at a certain point in time, and it did start rising after the bloodbath, right? So you can call it a cycle in terms of how the ARPU moved. Similarly, paint pricing can also stabilize at some point in time. Margin or dealer discounts can also stabilize at some point in time, and things will normalize, and then the velocity of change will reduce, or the velocity of disruption reduces, and things become fairly stable, and then they start reversing. What was structural in this entire play was valuations. Asian Paints as a commodity supplier, which is paints, if you say, is a commodity.
I'd call it branded commodity because they still earn really high gross margins on those.
That was temporary, no? I mean, that's what you saw getting evaporated as pricing reduced.
Okay.
And it reduced at 2 levels, right? Pricing reduced and commissions to dealers increased. Asian Paints was in a unique situation for multiple years where they were charging a pricing premium compared to industry, and they were giving lower commissions to dealers compared to industry. So they had a larger share in the middle, which sort of is shrinking now. What I would call structural is the fact that such a company in such a business was getting a certain multiple, which was appropriate for the situation which it was in. It could command a premium and a discount respectively on both ends, and hence it was trading at a premium valuation. If that environment itself changes structurally, because now there are new players coming in, that base valuation goes down. So I would divide your question into 2 parts and say maybe the earnings dilution is a cyclical event. However, my valuation dilution is a major structural event. And so even if things have to revive, my target multiple will never be what it historically got, but it will be now in context of the new dynamics in play. And that will make my investing decision much simpler because now I'll have a revised set of expectations in terms of my earnings as well as valuations. Even if earnings revive, my valuation will not, and hence my target price could be a little moderate or modest.
When we see these things happen, right? When we see something genuinely changing, are you implying, again, I'm just overstepping here, but are you implying that change in business is not as huge, but because stock prices are a function of valuations as well, and once that premium that these companies were getting, in this case Asian Paints, they get damaged to a point where it becomes a structural theme now. Market's perception gets structurally damaged, whereas business might not be as impacted. Or again, it's a case by case thing.
It really depends on the price at the end of it. I think the one mistake a lot of theoretical people do is that they treat the business in isolation, disconnecting it from the price. But when you're investing, the price also makes a large difference, right? So it always has to be looked at as what is the business and what is the price I'm getting it at. And the reverse is also true, where we've now spoken about a business that was structurally great or was getting a valuation that was supreme, and that sort of declined. There are multiple places where businesses, despite being good, were not really getting a certain valuation. And those sort of re-rate historically, re-rate massively as well. I'll give you an example of like BSE, right? BSE as a stock, there was a point maybe 5 years ago, pre-COVID or whatever, where it wasn't doing well. You were getting, at a point, I remember the stock was available at a price which is equivalent to the amount of cash and investments it had, plus its share in CDSL, plus the BSE building.
Really book value.
Yeah. And if you grabbed it up at that time, it was a multi-bagger for you. Has the business changed? Not really. Its share has increased. It has gotten better. Hath market has come a little ahead of what it used to be. It has gained maybe a decent share in, little bit of share in FNO, a little bit of share in whatever, right? The beauty of this business is that the fixed cost is pretty similar, or it remains stagnant. Whatever you add sort of multiplies on top. And as an exchange, I love the exchanges business, even NSE for that matter, right? Like you've got very high operating margins, very little reinvestment required, very high free cash flow, and a very high dividend coming in as well, because where will you reinvest the money? So it's a beautiful business to be in, provided you've got a certain scale in place and you cross that certain scale. So even in this case, has the business for BSE changed? Not real. Have they done things that have changed their fate in equity broking? Not materially. But the re-rating has been massive, right? Just by being able to sort of cross that threshold level. So you see cases here again, this is a structural change in how the valuations have moved. Have the business and valuations gone equally up? Business has gone little up, maybe valuations have gone massively up. So I don't think you can disconnect the two and look at it in isolation.
So business did go through a cycle post-COVID. We saw that equity boom, and everybody always knew that whenever such equity booms will come, players like exchanges will go through their cycle. But what you are implying is there was a structural trend that we saw on the valuation end of BSE, how the market started viewing BSE. And that eventually had a much higher impact on its stock price compared to the cyclical nature of their business itself, which did improve, but not as materially as the push it got from the valuation re-rating.
Yeah, and that's what I like about a lot of like commodity plays, which also have a structural angle there. I don't have a specific example, but say for example, it's a chemical company, which is simply buying a base chemical, processing it a little bit, and making an end chemical. That end chemical has certain uses. Now it adds a layer of process on top of it and further improves what it's making. The value add is more, and it's supplying high grade chemicals to, say, the pharma industry. That is a massive structural sort of re-rating that the stock sees, because now it's not looked at as a base chemical player, but it is looked at as a specialty chemical player. So I think these are also reflective in quarters, right? Because the announcement will be made in some quarter. Progress will happen in the subsequent quarters. Over time, the story will play out, which answers a lot about like the previous question also, how often do I track this? So if a company is moving from base to specialty, probably during that transition, I will track it every single quarter. Coming back to cyclical and structural, I love these companies also from the angle that they're disconnecting from cyclicality and moving to a more structural play. So I would also actively seek or try to look at, while differentiating between what is cyclical and structural, try to figure out what is moving from being cyclical to moving to being structural, and probably prefer that and play the transition, because I will get an opportunity to play the valuation re-rating only when it's migrating,
Yeah.
not later.
Not like
So Sagar, now I'll strip you of your identity as somebody who's working in finance. You're just a regular guy who does a corporate job. Maybe you're an automotive engineer. And this is me just having a conversation with you as a friend, trying to convince you why you should also look at quarterly results. And my pitch is very simple. Boss, the idea is that in the end, we're part of this democracy called India. Everything that happens in the economy affects us directly, indirectly, because we're staying here. And it's always good to be on top of such information. You do read, let's say, ET, Mint, Daily Brief, all of that is fine. You stay on top of it. But even these con calls and quarterly results are a good source of information for you as an individual. If you want to stay on top of, especially if it's an industry that relates to you. If you're an automotive engineer, it's more relevant for you to go through these con calls, because then you will be on top of all these things that these large companies are working on. This is my pitch to you. What do you say? Do you agree with it? Is it too much of a hassle? And do you think I should actually put more emphasis on reading all these quarterly results than ET, Mint, or all of these very general business sources?
It should be a part of the entire bouquet. There is no this or that for me. I think if someone's excluding this from their activity, maybe it's time to start including it. Also from the point of view of how easy it has become to get preliminary findings out of it, or forget preliminary findings, to use a few prompts and get more insights out of it, which we didn't have, say, 5 years back.
Is the incremental effort worth it?
Definitely, because it sort of gives you a on-ground reality check. You may have a situation where, for example, the macro numbers say one thing. The government is saying one thing in terms of what's happening, but it's not translating into on-ground benefits. Connecting that aerial view to your ground view, this definitely helps as an exercise. So I would not sit and say, for example, and I use this of going back 5 years, because you would have to, what is the effort it would take? You would have to download statements, view them, read con calls, or be on them, which is a high effort job, right? Now I think it's way easier. It takes a fraction of time to make sense of these things using AI. So is the incremental effort high? Not really. Is the incremental value add there? Definitely. Because we are talking about, even when it comes to strip everything off, talk about the 500 top companies in India. You're getting a sense of what the largest companies in India do and whether the macro is connecting down or not. And if you are in a certain industry, it definitely helps to know what is working, what is not working, position yourself as, develop your skill sets a certain way, position yourself in a career which will sort of go in a better direction than otherwise. So I feel it's important to know these things if you're in any industry.
Okay, let's reverse the roles. I am a dumb guy. You're trying to convince me. There are 500 companies. There are, I'm assuming, 20 plus sectors. I can't stay on top of all of them. Okay, I work in wealth. Maybe I'll read a thing or two about what are these brokers saying, what's happening on wealth management here and there. Okay, that's fine. But if I want to stay on top of the economy, what are a few companies? Okay, companies would be too specific, but sectors that I should look at. If you could name a few, that would be relevant for me. Okay, one thing that I like to do, because my job is also a bit related to the manpower hiring and IT spends to some extent, okay, not directly, but still, I would want to listen to what IT companies are talking about wage growth. Okay, so that's something that I know for a fact. That is relevant for me and my friends. I've just started my career. I want the wage growth to be good enough to support me for the next at least couple of years before I get unemployed by AI. But still, what are a few other industries you think are something worth tracking, not so complicated, but would be relevant for me? I don't know, maybe cement is too complex. I'm interested in auto maybe. I want to buy a car, maybe a few technologies here. How's the price moving for all these 4-wheelers, 2-wheelers? Okay, that's a bit relevant. But what other things do you think should one be on top of?
So I feel like I meet a lot of people who are sort of, it's the starting out consumer brands. A lot of people I know sort of just, because it's so much easier now to, compared to earlier, start a brand, manage distribution online, get a product made through a contract manufacturer up to your specs, scramble it up and give it a shot, give it a genuine shot to start a business which is a consumer facing brand. To know, for example, what an ITC, etc. are doing, all the FMCG companies, where are they seeing demand? Are they, which product categories they are seeing shrinkages in? Which product categories are they seeing pricing pressure in? what demographics are doing well or not. Where are some of these companies investing? So we're actively seeing a trend where people like Marico, ITC are investing in newer brands, which have been startups over the last few years, which have achieved a certain scale. Like Marico investing in Cosmix, you've got ITC investing in Prasuma. It'll, in general, if I am starting a consumer brand, it'll give me a look and feel of where the demand is. What is a market that is sizable? What is a market that is interesting for these companies? Where are some pockets available where I can probably launch something? So I feel like it's a great way for that context, for example. If I'm in general, say, in real estate, I would like to look at IT companies because in Bangalore, for example, they have driven a lot of the real estate demand over the last multiple years. If wages are coming off, if jobs are getting cut, if wage or volume growth is not happening on that front, I would want to sort of see where I will, as a real estate broker, for example, will I continue getting the same demand as earlier? If not, where will it be contributed by? If not the IT sector, what else will drive that kind of employability and that kind of generation of money in order to feed that? If I'm, for example, even in any industry, right, it just makes sense to look at it from a even premiumization perspective. Is my role appropriate for, am I being a cost center or am I being the center of where incremental growth is? I think it's necessary for everyone to just assess where they are in the overall scene and sort of relate to what they're doing. And you gave an example of wealth, like you're a wealth guy and is it relevant for you? I'll tell you this one thing where I have a lot of clients from varied industry. So there was a person who was working in the wires and cable space. And I had done some amount of research on that space and I could strike a much better conversation with him. He researches, he knows, he's able to have a conversation with me which is relatable, which is not looking showy, which is not superficial, which is not, and they discount it a little bit as well, right? They'll say, okay, you're not from the industry, so I will not hold you responsible for something that you say which is not completely accurate or which is a shade off. For me to be able to have these conversations with people who are in specific industries and convert them as clients is enough proof point for me to say that it's great from a knowledge perspective. And I think all this is coming from a very curious mind because we are both in research. We know that the core of being good at research is having curiosity. But for a lot of people, that curiosity may not exist. So you can't get them to be curious in any case, right? You can't force somebody to say that read quarterly results or go through these statements or listen to managements because you can't develop curiosity that way.
I think having the ability to strike interesting conversation with strangers, just on the back of the fact you've read about that industry in a quarterly con call, really does translate well for you, both professionally and personally. And that's something you and I experienced.
Yeah.
So I totally agree with you on that. Let's have this conversation and get back to, talking about quarterly results. You have written and consumed sell-side reports. You've also looked at how journalists cover sectors and even writers like me. I don't know whether you've read a couple of our stories, but a couple of things you think that journalists or, general people working in content like ourselves miss out when it comes to covering these sectoral quarterly stories. Keeping in mind that, again, the end consumer here isn't really a buy-side guy who has a very investing-oriented approach to it and really isn't making those decisions, but still would want to be on top of these things. What's one thing that we could, I personally could borrow from you think, that will help me do my job a bit better?
I'm going to club it together and say that generally, when you're writing for the audience, which is probably not well versed with finance, generally the writing stops at observations, doesn't go down to analysis. We're seeing that change with you guys, with a lot of other publications which are sort of going down that analysis route. Earlier, it would be only observations and not analysis. I feel like the value add comes from analysis. The one thing that sell-side reports do is excessive analysis. The one thing that financial content does is over observation. A middle ground, I think, is something that needs to be struck. But I feel like there's a lot of white space in the middle. But it's a very, very hard job, why we say it so simplistically, to convert something that is analytical into simple language. So, and that's a hard job to do, right? But if we're able to say, for example, it doesn't have to be very deep analysis, but just some of these connections that we spoke about in terms of evidence and numbers, in terms of if a company is investing X amount of money, just a simple thing to do in a quarterly result, for example, is how much is the incremental revenue I'm getting from something and what is the incremental capital I'm deploying in that particular business. Is it worth it or not? So there are a lot of companies that we see where the prime business is something and they're diversifying into other businesses. And there's other adhesives company, for example, getting into all sorts of other things, right? Including paints and cement and blah, blah. The incremental capital employed there is extremely high, but the amount of revenue there is very little. They are very large battles they are trying to fight. So the capital consumption game is going to be slightly longer term. The rewards are not going to be too much in terms of operating profit, and hence I can make a sense of the return ratios not being good. I can do a very deep financial analysis into it, but this can also be converted into something very simple, which is what is my capital allocation? It is 70% to new businesses, 30% to old. 70% is giving me 5% of additional operating profit at this point in time. If it has to even do justice, it's going to take 10 years. Is the company going in the right direction?
So the observation is the 70-30 part. Okay, where's the capital going? But the analysis is everything that happens after.
I feel the observation stops at saying that these guys are investing in XYZ business. What I'm calling analysis is even figuring out how much of their capital allocation is happening in that direction. And that is first level. Second level is how much are they getting in return or will they get in return over a period of time. And then the third level would be, that is investing, not but we can stop at level 1 or level 2, but also make it like a little more digestible for people.
And what's one thing you think like I should not borrow from the analyst community? One thing that comes to a couple of things, an overemphasis on the point decimal numbers and the accuracy with which, the confidence with which the analysts go towards accurately trying to predict those numbers. I think that's one thing doesn't do much just to maybe the kind of work that I do and the kind of content my audience would like to consume. But are there other things you think that maybe there's an overkill happening on analyst side, something that wouldn't really translate much well for me?
Okay, so these sell side reports are meant for the buy side, right?
Yeah.
I see a lot of people giving shade to analysts saying, oh, these are too detailed, these are not relevant, but that's not meant for you. Why are you reading something that is not meant for you and then criticizing what is written there? So I feel like this goes wrong horribly a lot of times. Because they consider these to be recommendations meant for the general public when they are not. These reports are getting published and are coming out in the open does not mean they were meant for you. So I feel like people go horribly wrong on that front where they say, oh, this analyst is saying whatever, he cut his target price, but cut his multiple, but increased his target price or something like that, right? Cut his EPS, but increased his target price. Or the analyst said buy and the stock went down. These are things, again, to be taken into a lot of context, which fund managers are able to consume because they're in that. So to be able to draw parallels of what the analyst is doing and relate to what can be done here is a little bit of a mismatch for me. But to be honest, I'd just say brevity is one thing because these run into pages and pages and pages, just making it concise and extracting what is important. Because out of 10 pages of whatever, I feel if you can't, and I keep saying this to any analyst that comes on board as well, you may write a 100-page report. But if you're not able to tell me the crux of it in a line that is not more than 20 seconds, I'm not sold on this. So the one thing to probably avoid doing is chasing length, chasing a lot of fillers, and probably just sticking to an actionable or that one insight that you're getting. And maybe just starting with that. I feel like we do a lot of context setting, and then somewhere like, what is the point of all this? That's the problem of a curious mind, right? You have to draw boundaries for your curiosity. So having an objective and sort of keeping it brief could be one thing that the sell side doesn't do that we have the advantage of doing on the other side.
Sagar, one last question before I let you go. Because everybody's talking about AI, I think we should also spend at least 5 minutes talking about it. How is AI making your life easier to read quarterly results? For me, again, because I keep switching context for every story that I write, I want synthesized and slightly concise version of what happened before, what's happening right now, in a very condensed format across a wide variety of literature that I'll have to go through. Okay, 3-4 investor presentations, 3-4 con calls. So AI does a lot of heavy lifting there by making sure that it's giving me those observations. But that's where I limit it. Obviously, I ask it to do a bit of analysis as well, which is a very hacky way for me to try justifying the job that I do, which is supposed to be analyzing. But that's how I approach it as a writer. When you approach it as a sell side or a buy side guy, how is AI helping you? Is it an extension of what we do, like what I just explained, or is it having totally new way of looking at things and using AI in a completely different lens?
I mean, if I have to put it very simply, how has it helped? It's reduce the number of people required, unfortunately, for the general public, and the time required. So if I had to do something over a period of 7 days and that required 2 analysts, I can probably do it in a period of 4 hours by myself. That's also because I have context, and the analysts wouldn't have context, and they would have to build it from ground up. So from that angle, I feel like I know the right questions to ask. And I'm saying this while being in the industry for say 14 years. I wouldn't have said this being in the industry for 2 years, because I would take longer, because I would have to explore a lot of ground before coming to ask the right questions, for example. So from my angle, I think it's amazingly efficient if I know exactly what I'm seeking. Even if I don't know what exactly I'm seeking, I know what to eliminate. So I'm kind of much more efficient in terms of getting somewhere. I'm able to also shift a lot of the heavy lifting, as you said, and in the relevant ways, right? For example, upload 5 annual reports together and get a certain analysis done and all of that, which was a very manual process earlier. Able to do a lot of that as well. So I feel like it has now, if my Claude runs out of credits, even on a $100 plan, if it runs out of credits, I'm almost at a stage where I feel like if the internet went right now, you'd be stuck at your job. I feel like that with my Claude only subjects.
You gave that answer from a person who's been in the industry for 14 years. I have been in industry for 2. You're talking about replacing me. So help me understand how I can use AI in the right way, because you make the best use of AI because you know what to ask and having that right context, asking those right questions. For somebody like me who's still trying to learn, most of AI usage that happens for me is to just build that context. You would have back in your day, you would have to go through all of these annual reports yourself to build that context. Now, okay, I can build that context in a much shorter time. But is that the only way how I can make best use of AI, especially when it comes to reading quarterly con calls? Because as you said, before I even go ahead reading a quarterly con call, I would have done that homework. For you, it would have been going through those manually. But now, with the help of AI, I can do that in a much shorter time. How do I optimize more? Is there more I can do to make sure that my life is a bit easier?
I think the edge always was how much you know or how much width you covered as an analyst, right? Like, for example, if I'm covering Indian companies and to get more context about how valuations move, why do I know that, for example, Asian Paints doesn't deserve that? Or commodity companies can't deserve that money. You'll have to look at other markets. You would probably earlier be restricted by the amount of time you had, because you were working 14, 16, 18 hours of jobs anyway and had certain deliverables. So you had restrictions in terms of how much time you're able to spend doing these things, which now get erased. So you're able to now add a lot more width into your research in a shorter duration. So a couple of things that I would really sort of ramp up on are looking at other markets, looking at longer cycles in a shorter duration, because now I'm able to sort of do much more. So I would analyze a lot more about what happens in good times, what happens in bad times. So a company's good time versus a sector's good time and bad time, and the economy's good time and bad time. How do those trends play out? I feel like you can fast track a lot of this learning now when it comes to the width, which is how many markets, how many peers you're looking at, the vertical, which is time, and probably even depth, because you're able to sort of upload too many documents at the same time and say, make sense of these, or including the evidencing that we spoke about. So the management is saying X, find it out for me. I'll give you another example, which took a lot of effort for me to analyze at one point in time. I was researching this chemical company. I'll not name the company right now, but I was looking at very heavy capital expenditure happening in that company. And the revenue growth that it was delivering was not really in line with the amount of capex it was doing. So there is a problem there. So I started looking at what is the capex happening towards. So you look at the gross block, you see where the addition is happening. You realize that 60 to 70% of the gross block addition incrementally is happening towards land and buildings and not towards machinery. Where the typical ratio for machinery in a chemical business like that is 60 to 70%. Whereas these guys were only investing about 20% in machinery. Again, that took me a lot of effort, because manually download annual reports, look at 5-year trends and then come to this. Look at outside geographies as well, whatever, all of that. What was the conclusion? That probably one of the conclusions could be that these guys are sort of showing capex and not really translating it into business outcomes. right? So land and buildings may not necessarily be in the factory. It just may be given to an external contractor, which is a promoter entity.
Got it.
And you keep refurbishing that and whatever. Or you refurbish the land and buildings at a massive premium compared to what the actual rate is or whatever. This analysis would have taken me, say, 3 weeks to, including other work. So that's, however, if I had to now do this, it could probably be a day's job. So I think just that curiosity translating into multiple dimensions and axis, which is across peers, across time and in depth, can do much more. So for anyone sort of starting the career out, right, I think what gives any analyst an edge is information asymmetry. Information asymmetry or better judgment. Both of these I feel can be leveraged using AI. So again, to put it in very simplistic terms, what am I looking to analyze when I'm taking an investing decision? What do my earnings look like and what does my valuation look like? If I'm, as an analyst, able to provide an edge in terms of judgment or information and get either of these or both of these right, I'm adding value. So that's all I would look to leverage.
Sagar, it's been a wonderful conversation. Thank you so much. I learned a lot. Hopefully the audience did too. That's it for this episode, guys. We'll see you in the next one.